You can ignore the daily similarities which occur from time to time. And there are times when it does occur. One time it didn't occur recently, for example, was when Trump got elected, the day after. It was an orgy of buying in the stock market and an orgy of selling in gold. So, his comment is true. Yes, the other day we had a similar drop. But look at what happened after the election. Gold dropped down to $2,540. Right now it's $2,650, by the way. It's well above that sell gold orgy after the election. In fact, it's above the levels it was prior to that orgy beginning. And the S&P right now, by the way, is back below the levels where its buying orgy began after the election. So don't look at the day-to-day. It's nonsense. Look at the bigger picture. And even in that regard, the panic selling that occurred that November 6th and 7th on gold and buying on the stocks was totally opposite.
To the Economy Express channel, where we deliver the latest insights and predictions shaping your financial future. I'm your host, and today we're diving into a monumental revelation for the silver market. Michael Oliver, a highly respected market analyst, is here to discuss what he believes could become the biggest silver bull market in history by 2025. Grab your coffee and settle in. This is a conversation you don't want to miss. Let's start by setting the stage. The stock market, a cornerstone of many investment portfolios, has been riding a wave of unprecedented distortion for the last 15 years. According to Michael Oliver, this distortion stems from artificially low interest rates set by central banks.
You don't have to be short the stock market, but just say, hey, I've had a great time. Especially if you got in at more optimal levels. We got major bullish in March of 2009 when it was, in fact, 2 weeks before it made the low. We said probably around 670. It went to 666. And we said, this is a major low. And no, we didn't know it'd last for 15 bloody years. No, of course not, And it had its breaks, ups and downs, and we called some of those. And frankly, it's been a lot longer than we expected. And while much of the market really peaked in 2022, like you'd look at small caps or a lot of sectors even never exceeded that high or only marginally did. But the S&P and the NASDAQ did, took out the 2022 highs. But it was largely at that point onward a leadership function of, half a dozen stocks. And everybody knows the Magnificent Seven or whatever they want to call it. But most of them, were in the NASDAQ 100. Front-end loaded, heavily weighted symbols, such as, 5 or 6 symbols basically were 50% of the entire index. And for the S&P, the same 5 or 6 symbols were about 30% of the index. So that's where the action was. It wasn't really breadth. And it persisted. And a fever came. And I'd say the fever particularly has been noticeable in the last quarter or so, but especially once Trump got elected.
Yeah.
There was a buying orgy by the Trumpers who thought, well, reality's going to change now, and things are going to go toward capitalism, supposedly, and less government and all that stuff. And, well, maybe and maybe not. But the point is, our point is that the reality is that there's a bubble there. You've had 15 years of distortion of price, and especially the cost of money. And when people have that distortion in their economic decision-making, the cost of money, it's an essential factor. If it's artificially low for 10 of the last 15 years, then you make decisions based on that. You commit money, you borrow money, you lend money based on premises that are not sustainable. And so when all of a sudden things start to get shaken and those errors start to get exposed, I'm talking real world now, then the hemorrhaging begins. And part of that hemorrhaging will show up in the areas where it's most distorted, and that would be the stock market, for one example. Not commodities. Commodities are still very low historically. They've had ups and so forth, but they're still historically low. So the real distortion was in the stock market, which is quite typical. And when it comes unwound, the central bank can change policy all they want, but it doesn't work. Never has. It does help something else, though. Monetary metals. Started MSA, but I didn't finish that first topic. In 87, after the crash, 92, we started MSA. And our clients up through 2015 were only institutional. Then we opened up to retail. But we've examined bonds all during that time. MSA looks at 4 categories: the interest rate markets, equity markets, not just ours, by the way, other equity markets, commodities broadly, especially the metals, monetary metals, and foreign exchange. Well, the bond market you're talking about here, the long end of the bond market, not the end that the Fed plays with, which is the short-term nonsense, but that 10-year, especially the 30-year, those T-bond futures have been around for a couple of decades now. They don't behave like the Fed rate cuts. You go back to September when they cut rates the first time, 0.5 point. Stock market rally, bonds sold off. Yields went up, not just the 30-year, but the 10-year. And then they cut them again the other day and then went down again. Price went down, yields went up. So, they're not in charge of that end of the market at all. Why? Because that end of the market's so huge that they can't play with that so much. They like to try to influence it. And right now it's got a stranglehold on reality because rates have stayed high since late 2022 on the long end of the debt market. If you look at a 30-year yield chart,
these rates have influenced financial decisions, from borrowing to lending, creating a precarious bubble in the process. Now, as markets begin to correct, the cracks in this foundation are becoming more visible. Michael warns investors to focus on the bigger picture. Daily market fluctuations might grab headlines, but they're often misleading. He points to historical trends as a guide, noting that past stock market crashes from 1929 to 2008 show us what happens when bubbles burst. During these times, investors have consistently sought refuge in safer assets, particularly gold and silver. Why? Because these metals maintain their value, even as currencies falter or markets collapse. Now, here's where it gets exciting. Michael?
No, the long-term trend in T-bonds is negative, meaning higher yields, lower price. But even in a major trend, you can have a counter-trend move. Markets inhale and exhale. The technicals for bonds look poised that once the stock market fractures itself initially, not the crash, just it starts to break 5% off the high, 10%, you'll see the T-bonds being pursued by asset managers who are looking for a place to be that is better in their perception than high-risk, low-reward stock market. And there's plenty of asset managers out there who've expressed doubts about the stock market based on, the long-term fundamental type metrics and assumptions. And they're right. It is distorted. It is way off the page. But the issue is the timing. But when you start to see that market crack, our bet is that the technicals that we see, the momentum technicals in T-bonds, could spark a sharp rally, a drop in yields. And not because the Fed's doing something. No, it's because people are seeking an alternative, a place to be that might be shelter. And the other place they're looking is gold and silver. And people don't realize it, but gold's up more on the year than the S&P. Nobody's cheering it though. It's up more % year to date than the S&P. Anyway, that'll be the other alternative. So that's why we're focused on the stock market, because when it does crack, money's going to flow. If you look at even a price chart, they're really not going down since 2022. They're just not going up. Yields aren't rising anymore. They're just not going higher, but they're not going lower yet. And the technicals look ripe for a spike, drop in yields, sharp rally in price in T-bonds, and it will highly likely, be coordinated with a break in the stock market. In fact, if you just punch up a weekly price chart of the S&P, go back to August, September, and see what it's done, and then look at the same chart of weekly T-bond futures. Opposites, total opposites. And that will reverse the other way when the stock market stumbles. You can ignore the daily similarities which occur from time to time. And there are times when it does occur. One time it didn't occur recently, for example, was when Trump got elected, the day after. It was an orgy of buying in the stock market and an orgy of selling in gold. So, his comment is true. Yes, the other day we had a similar drop, But look at what happened after the election. Gold dropped down to $2,540. Right now it's $2,650, by the way. It's well above that sell gold orgy after the election. In fact, it's above the levels it was prior to that orgy beginning. And the S&P right now, by the way, is back below the levels where its buying orgy began after the election. So don't look at the day-to-day. It's nonsense. Look at the bigger picture. And even in that regard, the panic selling that occurred that November 6th and 7th on gold and buying on the stocks was totally opposite and quite significant. But it didn't last. They've started to go back this way, okay? So I would ignore the day-to-day. Look at the bigger picture. And if you go back 100 years, 100 plus years, we just put out a report on this the other day. My son penned it. It was, where do you, a long-term investor, let's say somebody who's thinking 10, 20 years out, to park his portfolio. Stock market, it's ever up, right? No, it isn't. If you go back and examine carefully, there's many times, like 4 major times at least, where you'll have a major top in the market, a sharp drop, 28.9 to 32, for example. But it takes years to get back to the price level you saw prior to the drop. Oh yeah, there's an upturn. But when you also factor in the ongoing decay in the real value of the money, because of the increase in the money supply that occurs decade by decade, almost doubles every decade, then let's take NASDAQ 100, for example, 2000 dot-com top, it collapsed 82%. Well, if you didn't get out then, and we did say sell in January 2000, now it took a year before it really started down. But if you didn't get out in 2000, it took till 2016 to nominally get price back to where it was in 2000 for the NASDAQ 100. 16 years. You had to factor in 15 to 16 years, there was an ongoing decay in the real buying power of the dollar. So this thing's quoted in dollars, right? Okay.
Yeah.
So, yeah, it made a new high in 2016.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Michael is forecasting a seismic shift in the silver market. Based on his analysis, silver could experience growth of 20 to 50 times its current value by 2025. Yes, you heard that right, 20 to 50 times. The demand for silver isn't just rooted in its role as a financial hedge. Industrial demand, especially for renewable energy technologies and electric vehicles, is skyrocketing. Silver's dual role as both a commodity and a monetary asset places it in a unique position to benefit from economic uncertainty. Let's take a moment to talk about what's happening in the broader financial landscape. Michael emphasizes the importance of understanding the cost of money. For over a decade, interest rates were kept artificially low, leading to unsustainable financial behaviors. But when rates began to rise in late 2022, the reality of these distortions started to surface. Investors who borrowed heavily or made decisions based on low borrowing costs are now facing the consequences. And as the stock market teeters on instability, the ripple effects could be enormous. Historically, when stock markets falter, money flows into alternatives like long-term bonds and precious metals. Michael explains that these trends are no coincidence. Bonds, particularly the long end of the market, offer a temporary shelter during times of crisis. Similarly, gold and silver have consistently outperformed during market downturns. In fact, gold has already outpaced the S&P this year in terms of returns, yet it's not getting the attention it deserves. So, why is silver set to shine even brighter than gold? Michael attributes this to several factors. First, silver is significantly undervalued compared to its historical averages. Second, its industrial applications are expanding rapidly, with growing demand in sectors like solar energy and electric vehicles. Finally, silver is a smaller market compared to gold, meaning even modest investment inflows can have a dramatic impact on its price. Let's bring this back to you, the investor. Michael's key message is simple: ignore the daily noise. Instead, focus on long-term trends. As the stock market faces potential corrections, positioning yourself in assets like silver and gold could provide both safety and significant upside potential. He even goes as far as to suggest that the next major market correction will act as a catalyst for these metals, pushing their prices to unprecedented levels. To drive the point home, Michael shared a fascinating comparison of past market cycles. Take the dot-com crash in 2000, for example. It took the Nasdaq 16 years to recover to its previous high, and during that time, the purchasing power of the dollar eroded significantly. In contrast, gold prices surged from $260 per ounce in 2000 to over $1,900 in 2011. These patterns are not just history lessons, they're a roadmap for understanding where we might be headed next. Michael also highlights the role of asset managers in this equation. As confidence in the stock market wanes, these managers are likely to shift their portfolios towards safer investments. Bonds and precious metals will naturally become attractive options, with silver poised to benefit the most due to its unique market dynamics. As we wrap up, let's reflect on the broader implications of Michael Oliver's analysis. If his predictions hold true, 2025 could mark a turning point not just for silver investors, but for the global financial system as a whole. The time to act is now. Whether you're a seasoned investor or just starting to build your portfolio, keeping an eye on silver could be the smartest move you make this decade. Thank you for tuning into the Economy Express channel. Don't forget to subscribe for more expert insights and financial updates. Like and share this broadcast with your network. It could be the key to helping someone make a life-changing investment decision. Until next time, stay informed, stay prepared, and as always, stay ahead of the market.